Japan's 10-year bond yield spiked to 95 basis points for the very first time in more than a decade, but that jump couldn't contain a further rally in the dollar-yen, which rallied past the 150 level as the Bank of Japan's latest monetary policy decision remained, of course, again, short of some slightly hawkish expectations. Across the Pacific Ocean, the Fed starts its two-day monetary policy meeting today, and they will announce their latest monetary policy decision on Wednesday, and the US Treasury will reveal its bond issuance calendar for the final quarter of this year on Wednesday as well. But happily, investors are already a little bit relieved to hear that the US Treasury will actually borrow less money than they did last quarter, and even less money than penciled in by analysts. So welcome. This is Swissquote's Daily Market Talk. So the Japanese yen was gaining yesterday on expectation that the Bank of Japan would let the 10-year JGB yield shoot above the 1% mark as an effort to soften its inappropriately loose monetary policy. But gains remain short-lived yet again, and the dollar-yen shot above the 150 psychological mark after the BOJ decision. Even though the BOJ redefined the 1% level as a loose upper bound and scrapped its promise to keep that level intact, the move was seen as less aggressive than the one that was expected by the market beforehand. And the fact that the Bank of Japan said that they won't actually hesitate to take additional easing measures if needed somehow spoiled the sentiment in the Japanese yen as well. I mean, if needed for what, right? I mean, what's needed in Japan right now is not loosening the monetary policy. It's tightening it instead. Anyway, you heard it, is their monetary policy. They can do whatever they want with it, and they could loosen their monetary policy whenever they want to loosen it, and they can loosen it as much as they feel like they want to loosen it. So the dollar-yen trades just above the 150 mark this morning after the BOJ's decision, as I said, although the spike in the 10-year JGB yield to almost 1% should have actually pulled the pair a little bit lower, especially after the news that the US Treasury will be borrowing less money in the last 3 months of this year. Woo! Because they said yesterday that they are actually planning to borrow, still fasten your seatbelts, around 776 billion US dollars in the final quarter of this year. Now I know that's still a historically high borrowing figure, but it has the merit to be below the expectation of around 800 billion US dollars of borrowing from some big bank analysts, and it's also well below the 1 trillion US dollar that they actually borrowed in the July to September period, and which obviously did wreak havoc in the US bond market, sending especially the long end of the US yield curve rallying. Remember that? Yes, you do. Now today, the Fed starts its two-day monetary policy meeting, and tomorrow, Mr. Powell and company will be announcing their latest monetary policy decision. Now, yes, the FOMC announcement on interest rates on QT is often a big event for investors, but this time around, it won't be the only shining star of this week because, well, first, we genuinely know that there won't be any interest rate hikes in the US this week. The probability of a no interest rate hike is now priced as being almost 100% sure. The Fed members will certainly and still be raising a couple of eyebrows given the strength, the surprising strength of the recent economic data from the US, the uptick that we see in the inflation figures, and also the global uncertainty due to the geopolitical problems. But they won't necessarily be raising the interest rates this week, so what they will say that they will do will actually matter more for the market pricing than what they will do. And well, the rate expectations for the Federal Reserve will be played mostly for the December and the January FOMC meetings, which both hint at no rate hike either, by the way. So obviously we know that it's a long time and that could change, but for now, no more rate hike in the US is what investors are betting on. So, in the absence of a surprise rate decision, which won't happen, or a surprise forward guidance about a rate decision, which could eventually happen, what will really matter this week for the US sovereign space and also the faith of the US yields is the US debt situation and also the US Treasury Department's quarterly announcement on details, the buzzy and spicy details regarding the size and the maturity of the bonds that they will actually issue to borrow that extra 776 billion US dollars this quarter. Now, yes, we don't really talk about it every quarter, or we have never really talked about it as at least being almost as or more relevant for the bond yields than the Federal Reserve's rate decision itself, but with the US national debt now standing at nearly 34 trillion US dollars, with the rising interest rates which are supposed to stay higher for longer and which make the financing of this debt increasingly more expensive for the US, with the war in Ukraine that approaches its 2-year anniversary, it's not slowing down, and now with the war in the Middle East that unfortunately unexpectedly popped up this month, well, with the world turning its eyes, obviously, as a result of all this towards the US to see how it will manage to pay for all these extra expenses, because we all know that they have to do so. Well, the US borrowing calendar and the US borrowing numbers become the new buzzy news for investors. And of course, we also know that the Fed's recent tightening of the monetary policy, which simply means that they will not be buying this debt at all costs anymore, and the fact that we now see the downgrades by the big rating agencies are also adding to the worries of US debt holders these days. So this is basically why the US 10-year yield is now hanging around the highest level since 2007 and has potential to rise even more if the bond sell-off continues, of course. Now remember that some bond investors out there want to see the US 10-year yield at the 6% level before being fully convinced to buy them. And Bill Ackman, the famous Bill Ackman, was saying that the US 30-year yield would make sense at the 5.5% level if long-term inflation expectations in the US remain stuck at the 3% level instead of falling back toward the Fed's 2% monetary policy target. So here is your math: 3% inflation plus 0.5% real yield plus 2% maturity premium, and there you are, 5.5% yield for the US 30-year paper. So that's obviously scary math for the US Treasury. Therefore, the composition of the US Treasury's bond issuances will be crucial for investors in the coming months and quarters. Again, one of the major reasons which sent the long end of the US yield curve rallying over the past months in September was a more abundant issuance, and the issuance, a more abundant issuance of longer maturity bonds like US 10 and US 30-year papers. So everyone out there is now wondering whether Janet Yellen and her team would rely more on longer-term debt sales to cover this growing US deficit, or would they shift toward shorter-term bills due to rising yields. Now, shifting towards shorter maturity bonds could obviously relieve some pressure off the long-term paper's shoulders, but the problem with the short-term bonds is that the US Treasury already sold plenty of them before last quarter. I mean, they came close to their self-imposed limit of 20% disclose, and that's exactly why they actually did decide to sell more of these longer maturity bonds, which also explain why these long-term yields took a lift in the first place. So what I'm trying to say here is that it's not a given that the US Treasury's issuance calendar will fully calm down the bond investors' nerves on Wednesday, so you still be careful. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful. and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual, and follow us on Instagram, on X and on LinkedIn for regular market updates, and subscribe of course to our YouTube channel for daily market comments. And of course, please don't forget to hit the like button on these videos to let us know that you actually enjoy them. I will meet you again tomorrow, and until then, good day trading.